Beneath the surface of our global economy, beneath the familiar world of stocks, bonds, and real estate, lies another market. A market so vast, so complex, and so dangerously interconnected that most people don't even know it exists. It is a shadow financial system, a hidden architecture of colossal bets and counterbets. Its size is almost beyond human comprehension, an estimated $600 trillion. Let me put that number in perspective. $600 trillion is more than 30 times the entire gross domestic product of the United States. It is larger than all the stock markets, all the bond markets, and all the real estate on planet Earth combined. And the vast majority of this invisible empire, this financial house of cards, is controlled by just a handful of the world's largest megabanks. This is the derivatives market. And it is, without exaggeration, the largest and most unstable financial time bomb in the history of the world. In this video, we will not only explain what this monster is and how it was created, but we will also identify the specific real-world catalysts that could trigger its detonation, potentially as early as 2025. We will explore why Warren Buffett, one of the most respected investors of all time, famously called these instruments financial weapons of mass destruction. This is not a story about a potential market correction. It's a story about a potential systemic meltdown, a story you need to understand, because the fuse has already been lit. To comprehend the danger we face today, we must first understand how this shadow system has already brought the world to its knees once before. The financial crisis of 2008 was not a housing crisis. That is a dangerous oversimplification. At its core, it was a derivatives crisis. It was a dress rehearsal for the even bigger storm that is brewing today. So, what is a derivative? The name sounds complex, but the concept is simple. A derivative is not an asset itself. It is a contract that derives its value from an underlying asset. It's a side bet. Imagine two people watching a football game. They don't own the team, they don't own the stadium. They just make a bet with each other on who will win. That bet is a derivative. Now, imagine those bets are worth trillions of dollars, and the bet takers are the banks that hold all of our money. That is the modern financial system. The weapon of choice, the credit default swap, CDS. In the run-up to 2008, the most popular and ultimately most destructive derivative was the credit default swap, or CDS. A CDS is, in essence, an insurance policy. Banks that had created trillions of dollars in risky mortgage bonds wanted to protect themselves from the possibility of those bonds defaulting. So, they went to insurance companies, most famously AIG, American International Group, and bought insurance in the form of CDS contracts. But here is the critical, fatal flaw. Unlike regular insurance, where you can only insure a house that you actually own, in the derivatives market, anyone could buy insurance on anything. You didn't have to own the mortgage bond to buy a CDS on it. This meant that for a single $1 million mortgage bond, there could be 10, 20, or even $100 million worth of CDS bets stacked on top of it. It was like allowing 100 different people to buy fire insurance on your neighbor's house. It created a massive, hidden, and completely unregulated web of interconnected bets. The catalyst, the housing crash. As we know, the underlying assets, the subprime mortgages given to people who couldn't afford them, began to default in 2006 and 2007. The house that everyone was betting on started to burn. Suddenly, everyone who had bought the fire insurance, the CDS contracts, went to the seller to collect their payout. And the world made a horrifying discovery. The primary seller, AIG, one of the largest insurance companies in the world, had been operating like a reckless casino. It had sold hundreds of billions of dollars worth of these insurance policies without setting aside any money to actually pay the claims. They took the premiums, paid themselves huge bonuses, and assumed the fire would never happen. When the fire did happen, AIG was instantly insolvent. It owed more money than it could ever possibly pay. The systemic meltdown, counterparty risk. This exposed the ultimate danger of the derivatives market, counterparty risk. It's the risk that the person or institution on the other side of your bet will go bankrupt and be unable to pay you what they owe. Goldman Sachs, for example, was owed billions by AIG. If AIG went bankrupt, Goldman Sachs would not get paid, and it too could face a catastrophic liquidity crisis. And Goldman Sachs was connected to every other major bank. It was a chain reaction. The failure of one counterparty threatened to bring down the entire, tightly wound global financial system. The football bet analogy breaks down here. It's as if the bet was so large that if the bookie couldn't pay, the entire stadium would collapse. This is why the US government, in September 2008, had to step in with the largest bailout in corporate history and $182 billion injection of taxpayer money into AIG. They weren't bailing out AIG because they cared about its shareholders. They were bailing out AIG to save AIG's counterparties, the very same megabanks that had created the mess in the first place. The 2008 crisis proved, without a shadow of a doubt, that the derivatives market was not a sideshow. It was the central nervous system of the financial world, and it was terminally ill. The lesson of 2008 was supposed to be clear. The unregulated derivatives market was a systemic threat that needed to be contained. Politicians promised reforms. New regulations like the Dodd-Frank Act were passed. The public was assured that the system had been made safe. But has it? Let's look at the hard data. This is where the story moves from alarming to terrifying. The scale of the behemoth. Notional value. Today, the total notional value of the global derivatives market is estimated to be anywhere from $600 trillion to over $1.5 quadrillion. Let's use the conservative number. What does notional value mean? It's not real money, but it is a measure of the total value of the underlying assets on which all the side bets have been placed. It represents the sheer scale and interconnectedness of the system. If the 2008 crisis was a fire in a large building, the notional value today represents a fire hazard in a city of skyscrapers made of dynamite. The problem has not been solved. It has metastasized. The market is larger, more complex, and more opaque than it was in 2008, and the risk is even more concentrated. The four horsemen of the apocalypse. According to the official reports from the U.S. Office of the Comptroller of the Currency, or OCC, a staggering 90% of the entire derivatives market in the United States is held by just four banks: JP Chase, Bank of America, Citigroup, and Goldman Sachs. These are the same too-big-to-fail banks from 2008, now bigger and more systemically important than ever. JP Chase alone holds a derivatives book with a notional value of over $50 trillion. That single bank's derivatives exposure is more than double the size of the entire U.S. economy. This is the very definition of systemic risk. The financial health of the entire global economy now rests on the stability and risk management of a tiny handful of institutions that are all inextricably linked to each other through this invisible web of derivatives. The hidden dangers: interest rate swaps. While credit default swaps caused the 2008 crisis, they are only a tiny fraction of the market today. The largest and most dangerous part of the derivatives market is in something that sounds boring: interest rate swaps. This market segment alone has a notional value in the hundreds of trillions. What are they? In simple terms, they are bets between large institutions on the future direction of interest rates. For example, a bank might agree to pay another bank a fixed interest rate for the next 10 years, and in return, the second bank agrees to pay the first bank a floating interest rate. It's a way for institutions to hedge against risk. But here's the danger. For the last decade, the world has lived in an artificial environment of near-zero interest rates. The entire $600 trillion house of cards has been built on the assumption that interest rates would stay low forever. But now, with central banks around the world being forced to raise interest rates aggressively to fight inflation, that assumption has been shattered. The very foundation of the derivatives market is now shaking violently. A sudden, unexpected move in interest rates could trigger catastrophic losses for one side of these trades, setting off the same kind of counterparty risk chain reaction that we saw with AIG in 2008, but on a scale that would make 2008 look like a minor tremor. So we have a system that is larger and more concentrated than ever before, built on a foundation of unstable interest rates. The bomb has been built. All it needs is a detonator. What could be the catalyst that triggers the next great derivatives crisis? There are several prime candidates, and the fuses are already burning. Catalyst 1. The commercial real estate crisis. The post-pandemic world has seen a permanent shift to remote work. Office buildings in major cities are sitting empty. This has created a slow-motion train wreck in the commercial real estate market. The owners of these buildings have massive mortgages to pay, but their rental income has vanished. Defaults are beginning to skyrocket. Why does this matter for the derivatives market? Because the regional and commercial banks that hold these multi-billion-dollar loans are the same institutions that are deeply enmeshed in the derivatives web. A wave of commercial real estate defaults could bankrupt dozens of medium-sized banks. Each failure would trigger defaults on their derivatives contracts, sending shockwaves of counterparty risk upwards to the big four megabanks, potentially creating a Lehman moment that starts not on Wall Street, but in the empty office towers of America. Catalyst 2. A major corporate or sovereign default. The decade of easy money has allowed corporations and even entire countries to take on unprecedented levels of debt. Many of these entities are now zombies, only able to survive by constantly borrowing new money to pay off the old. As higher interest rates bite, a major, unexpected bankruptcy is no longer a question of if, but when. Should a major corporation or a European nation like Italy default on its debt, it would immediately trigger billions, perhaps trillions, of dollars in credit default swaps. We would face an AIG-2 scenario. The world would suddenly wake up and ask the terrifying question, who insured this debt, and do they have the money to pay? The resulting panic and search for the hidden counterparty risk could freeze credit markets overnight. The domino effect, a systemic cascade. This is how the final meltdown would unfold. It starts with a catalyst, a wave of defaults in a specific sector. This causes a major derivatives player to fail, unable to meet its obligations. This failure triggers counterparty risk across the system. Suddenly, no one knows who is safe. Banks, fearing their counterparties might go bankrupt, stop lending to each other. This is called a credit freeze. When credit freezes, the real economy dies. Businesses can't get loans to make payroll. Trade finance stops, meaning ships stop moving. ATMs could stop working. It would be a repeat of the days after Lehman Brothers' collapse, but potentially far worse because the system is now far more leveraged and interconnected. The financial weapons of mass destruction that Buffett warned about would finally be detonated, and the fallout would hit every single person on the planet. After the near-death experience of 2008, a wave of public fury and political promises swept across the globe. The message was clear, a solemn vow from the world's leaders and regulators: never again. They assured the public that the system had been fundamentally reformed, that the Wild West of finance had been tamed. New, complex, and sweeping regulations, most notably the Dodd-Frank Wall Street Reform and Consumer Protection Act in the United States, were put in place. These laws were designed to increase transparency, force derivatives trading onto centralized clearinghouses, and require banks to hold more capital as a buffer against losses. On paper, it sounded like a comprehensive solution. But has this complex web of new rules created genuine, resilient safety, or has it merely engineered a more sophisticated and deceptive illusion of it? Many of the most astute critics of the financial system argue that the core, fundamental problems were never truly solved. The mantra of too big to fail was the central lesson of 2008. Yet today, the too big to fail banks are, by every conceivable measure, bigger, more powerful, and more interconnected than they were before the crisis. The market share of the top 4 American banks has actually increased. Their derivatives books are larger. Their political influence, through armies of lobbyists, remains immense. The very same institutions that were at the epicenter of the last crisis remain at the absolute heart of the global financial system today. We didn't break them up, we made them bigger. Furthermore, while it's true that some segments of the market, particularly standardized derivatives like certain types of swaps, have been pushed onto central clearinghouses to reduce direct counterparty risk between banks, this may have only shifted the problem, not solved it. Now, these central clearinghouses themselves have become single points of failure. A collapse of a major clearinghouse could be even more catastrophic than the collapse of a single bank. More importantly, a vast, murky portion of the derivatives world remains a complex, opaque, over-the-counter, OTC, web of bilateral agreements. These are custom, bespoke contracts traded directly between two parties, hidden from public and even most regulatory view. No single regulator, no single government has a complete, real-time picture of who owes what to whom across this multi-hundred-trillion-dollar shadow network. We have simply papered over the deepest cracks of a fundamentally unstable structure, hoping the wallpaper holds. The greatest danger of all, however, is a psychological one: complacency. The pervasive belief that because we survived the big one in 2008, we now have the tools and the wisdom to prevent the next one. But history teaches us a different, harsher lesson. Financial crises often recur precisely when the memory and the fear of the last one fades. Risk-taking behavior, emboldened by years of bailouts and central bank support, always returns, often in a new, more complex, and more hidden form. The financial weapons of mass destruction that Warren Buffett warned about were not dismantled after 2008. They were simply given a new coat of paint, upgraded with more complex software, and moved to a deeper, darker, and more interconnected silo. The $600 trillion derivatives market is the ultimate black swan event waiting in the wings of the global stage. It operates almost entirely out of public view, a topic deemed too complex for the nightly news, too intimidating for most politicians to meaningfully address. Its very complexity serves as its greatest defense, a shield of jargon and mathematical obscurity that keeps scrutiny at bay. But understanding its basic, brutal mechanism, the simple concept of a promise, the profound danger of a broken promise, the chain reaction of counterparty risk, and the devastating domino effect is not optional for anyone who truly wants to comprehend the fragility of our modern financial system. It is the hidden architecture of global financial power, the invisible plumbing that can either facilitate commerce or flood the entire world with toxic contagion. Jesse Livermore saw the psychological cracks in the euphoric market of 1929. Michael Burry saw the mathematical cracks in the fraudulent mortgage bonds of 2008. Today, the cracks are structural, hidden deep within the incomprehensibly vast and interconnected web of the derivatives market. Recognizing them requires a willingness to look deeper than the headlines, to question the assurances of safety, and to respect the lessons of history. If this exploration of the world's largest and most dangerous market has provided you with a new awareness, a new framework for understanding the systemic risks we collectively face, then I invite you to subscribe to Economic Echoes. Because in a world of ever-increasing financial complexity, our mission is not to predict the exact moment of the storm, but to understand the atmospheric pressures that are building. We are here to shine a light into the shadows, to translate the complex into the comprehensible, and to read the architectural blueprints of the financial world, together, before the tremors begin.